This simulation captures the raw mechanics of rapid price action. We watch forces violently push upward against a hard structural barrier, only to see those forces collapse backward into a cascade. When you trade, you are reacting to this exact kind of rapid momentum. You learn to map structural boundaries, and eventually you watch a classic breakout unfold. Price approaches a known macro resistance line and pushes straight through it, printing a massive, aggressive green candle. The move looks undeniably strong. You wait for the breakout, you buy the strength, and then the structure fails. The breakout candle instantly wicks back, reverses direction, and traps you in a sudden, punishing flush. Retail traders experience this sequence and point to market manipulation. They assume larger entities saw their specific order and intentionally targeted their stop loss. In the reality of tape physics, no one targeted your specific order. You have simply committed the severe error of reading the price structure while forgetting to check the underlying execution fuel gauge. Price action is merely advertising. The market moves price wherever it must go to find liquidity, but the true intent behind that movement is dictated entirely by underlying volume flow. This visual represents the boundary between what amateurs see and what professionals measure. To decode the life cycle of volume, we step into the unseen execution engine below. We track institutional absorption using a precise three-part momentum code: the A-wave, the B-wave, and the C-wave engines. Analyzing price structure without verifying the exact chronological flow through these three engines leaves a trader blind to the distribution occurring behind the bid, often turning a retail position into the very liquidity an institution needs to exit its own. The tape operates on a strict sequence, beginning with a simple axiom: markets cannot trend without initial aggressive force. Looking at this first engine panel, we see the A-wave. This tracks the primary aggressive market order impulse. When institutions initiate a move, they sweep the order book using market orders, creating this distinct volume spike aligned directly with the upward price candle. This establishes our validation rule. A structural breakout accompanied by a massive A-wave proves that the initial move has real institutional backing. Conversely, if price breaks a critical structural level, but the A-wave histogram remains flat and completely empty, the momentum is a structural mirage. A tall, aggressive price candle masking an empty momentum engine is exactly how traders get trapped buying into zero-gravity air. Tracking the A-wave forces you to wait for actual fuel, preventing you from buying into a completely unsupported trend. Once the initial drive tires out, the market transitions into the second chronological phase. It enters a tight compression or sideways consolidation. During these sideways compressions, retail traders behave predictably. They get bored, they range trade, and they cluster their stop-loss orders directly outside the local highs and lows of the structure. This middle panel is the B-wave engine, tracking algorithmic behavior around retail liquidity. Algorithms intentionally drive a fast candle straight through the consolidation floor to trigger resting stops. While amateurs panic sell, the B-wave flags this anomaly, printing a distinct yellow signal. This visual spike measures one precise event: a sudden surge in passive limit order absorption by institutions. We define this specific execution as a deep B liquidity sweep. The algorithms used the panic selling of retail traders to fill their own buy orders at a deep discount, packing the compression with explosive fuel for a counter-trend launch. Mastering the B-wave allows you to observe a range breakdown and immediately identify whether it is a genuine structural failure or a predatory discounting operation. The final chronological phase of a market move revolves around structural rebalancing and the total exhaustion of the cumulative volume delta. Aging uptrends operate on surface-level deception. Print after print, the price continues to grind higher, making the market look perfectly healthy and robust to the naked eye. We expose this hidden lie using the bottom panel, the C-Wave engine. Notice the institutional absorption divergence. The top price chart steps upward, printing a higher high, while the C-Wave histogram peaks dramatically shrink into a lower high. This forms an exact geometric contradiction. The tape physics dictating this divergence are straightforward. The aggressive buying fuel has dried up completely, and the price is only floating upward due to a temporary lack of friction. Behind the scenes, smart money is resting passive sell orders at these higher levels. They are systematically distributing their accumulated positions to the retail traders arriving late to the breakout. The moment the final retail buyer fills their position, the active demand required to sustain the higher price level evaporates. With no remaining aggressive orders to lift the offer, the engine stalls and the market rebalances through a sharp downward flush. Tracking this C-wave divergence serves as a mathematical early warning system, ensuring you never act as the final buyer at the absolute top of an exhausted trend. To execute high-probability trades, you abandon isolated indicators. You build a singular execution blueprint by stacking multiple timeframes and models together. We call this specific alignment the nuclear junction. It is the precise moment when trend gravity, price structure, and volume flow synchronize. A broad macro line provides a directional tailwind. Localized price pulls back, landing exactly on this 40% support wall. Instantly, the B wave flashes a massive yellow liquidity sweep spike. Simultaneously, the C wave locks in a perfect bullish divergence, confirming the evaporation of sell pressure. This alignment provides a clear operational framework. Macro gravity is behind the trade, retail stops are cleared, and the tape proves massive institutional absorption. Professional execution relies on calculated alignment, not gambling on surface-level patterns. You secure your edge by synchronizing chronological volume intent with the structural gravity of the market.